Good day. I will be discussing about Chapter 9, Differential Analysis and Product Pricing. So what is a differential analysis? So it is a management accounting technique in which we examine only the changes in revenues, costs, and profits that result from a business decision instead of creating complete income statement for each alternative. So it is also called an incremental analysis. So managerial decision making involves in choosing between the alternative courses of action. Although the managerial decision making process varies by the different type of decision, it normally involves in the following steps. So first, we have to identify the objective of the decision, which is normally maximizing income. Second would be identifying alternative courses of action. And third is gathering information and perform a differential analysis. Fourth is making a decision. And lastly is to review, analyze, and assess the result of the decision. So as what I have said earlier, differential analysis is also called incremental analysis. So it analyzes differential revenue and cost in order to determine the differential impact on income of the two alternative courses of action. Differential revenue is also the amount of increase or decrease in revenue that is expected from a course of action compared to an alternative. So differential cost is the amount of increase or decrease in cost that is expected from a course of action as compared to an alternative. So differential income or loss is a difference between the differential revenue and differential cost. So the difference between two is that the differential income indicates that a decision is expected to increase income, while a differential cost indicates the decision is expected to decrease income. So we have here an example of differential analysis in Exhibit 1. So it has 3 columns where the positive amounts indicate the effect to increase income and negative amounts indicate the effect to decrease income. So in first column is the revenues, cost, and income for maintaining floor space for tables under alternative 1. The second column is the revenues, cost, and income for using the floor space for salad bar under alternative 2. And lastly is the third column, the difference between the revenues, cost, and income of the alternative over the other. So in this exhibit, we can see that the salad bar is being considered over retaining the existing tables. Thus, column 3 is expressed in terms of alternative 2 or the salad bar over alternative 1 or the tables. So the differential revenue of the salad bar over tables is $20,000. So how did we come up with that? We have here the formula below and it will be discussed later on. So because of the decreased revenue would increase income, it is entered as a positive $20,000 in a differential effect on income column. The differential cost of a salad bar over tables is negative $5,000. Because the decreased cost will decrease the income, it will be entered as a negative $5,000 in a differential effect in column of income. So the differential income or loss of a salad bar over tables is $15,000 is determined by subtracting the differential costs from the differential revenues in the differential effect on income column. Thus, installing a salad bar increases income by $15,000. The preceding differential revenue, cost, and income can also be determined using the formulas. Here we have first we have here the differential revenue. So we have to subtract revenue under alternative 2 minus the revenue under alternative 1. So we have here a negative $120,000 subtracted by $100,000, so we come up with $20,000. Second, for the differential cost, we have to subtract a cost under alternative 2 minus cost under alternative 1. So we have negative $65,000 minus negative $60,000. So we come up with a negative $5,000. Differential income or loss can be come up by subtracting income from alternative 2 minus income from alternative 1. We have here $55,000 minus $40,000, summing up with $15,000. So now let's proceed to lease or sell. Management may lease or sell a piece of equipment that is no longer needed. These may occur in a company changes its manufacturing process and can no longer use the equipment in the manufacturing process. In making a decision, differential analysis can be used. So only the differential revenues and the differential cost associated with the lease or sell decision are included in the differential analysis. So the book value of the equipment is a sunk cost and is not considered in the differential analysis. So what do you mean by sunk cost? So these are costs that have been occurred in the past and are not relevant to future decisions. So let's say when a company upgraded its equipment, so the company or the office should decide whether they should have to lease it or sell it. So to give an illustration, we have here Marcus Company. So they are torn between leasing or disposing an equipment. So we have here given the figure. So under Exhibit 2, these can be applied in differential analysis. So there's a comparison between if they will lease an equipment or sell it. So under leased, we have in column 1 with the revenue, with the income of $125,000, and in under column 2, if they will sell an equipment, so that is option 2 for them, we have $94,000, and for the third column is the differential effect on income. So the next topic is discontinue a segment or product. So if you guys are working or if you have a business, I think we encounter this. For instance, when a company do cost cutting, whether in the product or materials that we are using, or let's say under marketing, if the sales commission are being eliminated. So a product, department, branch, territory, or other segment in a business may be sometimes let's say generating losses. So as a result, the management may consider eliminating the product or segment. So in such cases, it can be assumed that the total company income will increase by eliminating the operating loss. Discontinuing the product or segment usually eliminates all of the products or segments' variable costs. Such costs include direct materials, direct labor, variable factory overhead, and sales commission. However, fixed costs such as depreciation, insurance, and property taxes may not be eliminated. Thus, it is possible for total company income to decrease rather than increase if the unprofitable product or segment is discontinued. So we have here in Exhibit 4 an example of differential analysis, whether the company should continue using brand flake under column 1, or if they will no longer use the product under column 2, and the differential effect on income under column 3. So differential analysis can also be used when a company is torn between making a product or buying it. So companies often manufacture products made up of components that are assembled into a final product. So for example, an automobile manufacturer assembles tires, radios, interior seats, and transmissions and other parts into a finished automobile. So in such cases, the manufacturer must decide whether to make a part or purchase it from a supplier. So differential analysis can be used to decide whether they will make it or just buy it. So the analysis is similar whether management is considering in making a part that is currently being purchased or purchasing a part that is currently being made. So to illustrate, so assume that an automobile manufacturer has been purchasing instrument panels for, let's say, $240 a unit. The factory is currently operating at 80% of capacity, and no major increase in production is expected in the near future. So the cost per unit of manufacturing an instrument panel internally is estimated, let's say a specific date, February 15, so as follows. So direct materials, we have here the figures. Direct labor, variable factory overhead, fixed factory overhead. So the total cost per unit, let's say, is $280. So we have here in Exhibit 5 the comparison between making or buying instrument panels. So under column 1, we have whether the company should make panels, and in column 2, if the company will buy panels, and lastly in column 3, the differential effect on income. So we should also take note that other factors should also be considered in the analysis. For example, productive capacity used to make the instrument panel would not be available for other production. So decision may also affect in the future relationship with the instrument panel supplier. For example, if the supplier provides other parts, the company's decision to make instrument panels might jeopardize the timely delivery of the other parts. Differential analysis can also be used when a company will replace an equipment. The usefulness of a fixed asset may decrease before it is torn out. For example, an old equipment is no longer as efficient as a new equipment. So differential analysis can be used for decisions to replace fixed assets such as equipment or machinery. The analysis normally focuses on the cost of continuing to use the old equipment versus replacing the equipment. The book value of the old equipment is a sunk cost, thus it is now irrelevant. So to illustrate, so let's assume that a business produces kerosene as an immediate product. So we have here the data below. So we have here the batch sizes, let's say 4,000 gallons. Cost of producing kerosene, $2,400 per batch, and selling price would be $2.50 per gallon. So under in Exhibit 6, we have here the differential analysis, whether the business will continue to use the old machine under alternative 1 or replace the old machine under alternative 2. So under column 1, the data, whether they will continue to use the old machine, and under in column 2, if they will replace the machine, and lastly under in column 3, the differential effect on income. So this analysis can also be used if the business or the company will process or sell the product. So during manufacturing, a product normally progresses through various stages or processes. In some cases, a product can be sold at an immediate stage of production, or it can be processed further, then sold it, or then sell it. Differential analysis can also be used to decide whether to sell a product at an immediate stage or process it further. In doing so, differential revenues and costs from further processing are compared. So the costs of producing the immediate product do not change, regardless of whether the immediate product is sold or processed further. So we have here an illustration below, assuming that the company produces kerosene as an immediate product. So we have here the data. So the kerosene can be processed further to yield gasoline. So we have here by batches or input batch size, less evaporation up to 20%, so the output batch size, and the cost of producing gallon and the selling price. Moving on, we have here the concept of accepting business at a special price. So a company may be offered the opportunity to sell its products at prices other than normal prices. Let's say, for example, an exporter may offer to sell a company's product overseas at special discount prices. So differential analysis can be used to decide whether to accept additional business at a special price. The differential revenue from accepting the additional business is compared to the differential cost of producing and delivering the product to the customer. So the differential costs of accepting additional business depend on whether the business or the company is operating at less than capacity. So if the company is operating at less than full capacity, then the additional product does not increase a fixed manufacturing cost. However, selling and administrative expenses may change because of the additional business. So to illustrate, we have here the data below of the B-Ball Incorporated. So they produce basketballs. So we have here the data of the monthly productive capacity, current monthly sales, the value of the normal selling price. So we also have here the manufacturing cost, the variable cost, and fixed cost. So given from the data earlier, here in Exhibit 8 is a differential analysis whether the company will reject the order or accept it. So we have here in column 1, or alternative 1, the first option is whether they will reject the order, and the second option is to accept the order under column 2, and in column 3 we have the differential effect on income. So proposals to sell products at special prices often require additional considerations. Let's say special prices in one geographic area may result in price reductions in other areas, with the result that the total company sales revenue decreases. Now we will be discussing setting normal product selling prices. So what does that mean? So the normal selling price is the target selling price to be achieved in the long term. It is also, or it must be set high enough to cover all costs and expenses, whether they are fixed or variable, and provided with a reasonable profit. So managers can use 1 to 2 market methods to determine the selling price. So first, we have the demand-based concept. So this concept sets the price according to the demand of the product. So if there is a high demand of the product, then the price is set high. And if the demand is low, so then the price is set low. So second would be the competition-based concept. So in this concept, it sets the price according to the price offered by the competitor. Managers can also use one of the 3 cost-plus methods to determine the selling price. So these are the following. First, we have the product cost concept. Second, the total cost concept. And third, the variable cost concept. So what do you mean by the product cost concept? So this determines the normal selling price by estimating a cost amount per unit and adding a markup computed as follows. So this one, a normal selling price would be the cost amount per unit plus the markup. So management determines the markup based on the desired profit of the product. And the markup should be sufficient to earn the desired profit plus cover any costs or expenses that are not included in the cost amount. The product cost concept applies using the following steps. So first, we have to estimate the total product cost, which is the total value of the direct materials, direct labor, and the factory overhead. So second step is to estimate the total selling and administrative expenses. Third step would be dividing the total product cost by the number of units expected to produce or sold to determine the total product cost per unit. So it is the product cost per unit. So we have to divide total product cost with the estimated units produced and sold. So the fourth step is to compute the markup percentage. So how do we compute that? So we have the desired profit plus the total selling and administrative expenses divided by the total product cost. So the desired profit is normally computed based on the rate of return on the asset. So the desired profit is equivalent to the desired rate of return times the total asset. The fifth step is to determine the markup per unit by multiplying the markup percentage times the product cost per unit. And lastly, the sixth step is to determine the normal selling price by adding the markup per unit and the product cost per unit. So we have here an example below under Digital Solutions Incorporated. So for 100,000 calculators, they're expecting to produce and sell during that year, or during this year. So we have here the data. The direct materials is $300,000, which came from $3 times 100,000 calculators. So direct labor is $1 million. So the factory overhead is 200, and the total manufacturing cost is $1.5 million. The selling and the administrative expenses is $170,000, and the total cost is $1,670,000 dollars, and the total asset is $800,000. So desired rate of return is 20%. So by applying the steps I've mentioned earlier, the normal selling price is $18.30. So by applying those steps, we have here for the first step is the total product cost amounting to $1.5 million, and the second step is the total and the administrative expenses that was already given in the data, which is $170,000. And the third step is the total product cost per unit, which is $15. So we have here the total product cost amounting to $1.5 million divided by the estimated units produced and sold, which is 100,000 units. So we came up with $15. So the fourth step is the markup percentage, which is 22%. So the desired profit is equivalent to the desired rate of return times the total asset. So we came up with $160,000. So the markup percentage is the desired profit plus the total selling and administrative expenses divided by the total product cost. So we have here given the data, we came up with 22%. The fifth step is the markup per unit, which is $3.30. So the markup per unit is the markup percentage times the product cost per unit. So we have here 22% times $15, equivalent to $3.30 per unit. So the last step is adding the total product cost per unit, which is $15 plus the markup per unit, which is 3.30. So the normal selling price per unit is $18.30. Product cost rather than actual cost may be used in computing the markup. So the management, we should take note that the management should be careful when using estimated or standard costs in applying the cost plus approach. Specifically, estimates should be based on the normal or the attainable operating levels and not the theoretical levels of performance. In product pricing, the use of estimates based on the idea operating performance could lead to setting product prices too low. So target cost is also determined by subtracting a desired profit from the expected selling price. So computing that the target cost is equivalent to the expected selling price subtracted by the desired profit. Also, the target cost is normally less than the current cost. So managers must try to reduce costs from the design or manufacture of the product. So the planned cost reduction is sometimes referred to as the cost drift. So costs can be reduced by first simplifying the design, second reducing the cost of the direct materials, and lastly reducing the direct labor cost. The next topic is production bottlenecks. So it is also called a constraint, and it's a point where in the manufacturing process in a company, demand for the company's product exceed the ability to produce the product. So the theory of the constraint, or the TOC, is a manufacturing strategy that focuses on reducing the influence of bottlenecks on the production process. So when a company has a production bottleneck in its production process, it should attempt to maximize its profit subject to the production bottleneck. So in doing so, the unit contribution margin of each product per production bottleneck constraint is used. So we have here an example under the Pride Craft tool company. So they make 3 types of wrenches, which is the small, medium, and large. All 3 products are processed through a heat treatment operation, which hardens the steel tools. So the company heat treatment process is operating at full capacity and is a production bottleneck. So the product unit contribution margin and the number of hours of heat treatment used by each type of the wrenches. So we have here a data below. Under the small wrench is the unit selling price is $130. For medium we have $140, and for large we have $160. So the unit variable cost is the same, 40, and the unit contribution margin for small is $90. Heat treatment is 1 hour per unit. For the medium we have $100, and for heat treatment hours is 4 hours, and lastly for the large is $160 with its unit contribution margin of 120 for 8 hours. So in getting the unit contribution margin per bottleneck constraint is getting the dividing unit contribution margin to heat treatment hours per unit. So the unit contribution per production bottleneck hour for each of the wrenches produced by the company is computed in the example below. So the small wrench produces the highest contribution or unit contribution margin per production bottleneck or the heat treatment of $90 per hour. In contrast, the large wrench has the largest contribution margin per unit of $120, but has the smallest unit contribution margin per production bottleneck hour of $15 per hour. Thus, the small wrench is the most profitable product per production bottleneck hour and is the one that should be emphasized in the market. Let's now proceed to total and variable cost concept to setting normal price. In getting the normal selling price, we have a cost amount per unit plus the markup. So the management determines the markup based on the desired profit of the product, and the markup should be sufficient to earn the desired profit plus cover any costs or expenses that are included in the cost amount. So the product cost concept was discussed in the chapter, and the total variable cost concept are discussed in the appendix. So in getting the total cost concept, we have a manufacturing cost plus the administrative cost plus the selling cost. So we have to apply the steps here for the total cost concept. So first step is to eliminate the total estimate the total manufacturing costs. So which are the following? We have here the direct materials plus the direct labor and the factory overhead. So second is to estimate the total selling and administrative expenses. Usually this is already given in the problem. And third is to estimate the total cost. So total cost is the
to get it, we have a total manufacturing cost plus the selling and administrative expenses. Now for the step 4 is to divide the total cost by the number of units expected to be produced and sold to determine the total cost per unit. So we have here total cost per unit. By getting it, we have to divide total cost by the estimated units produced or sold. So the 5th step is to compute the markup percentage. In getting it, we have to divide desired profit over the total cost. So the desired profit is normally computed based on the rate of return on assets. So desired profit, in getting it, we have to multiply a desired rate of return times the total assets. So the 6th step is to determine the markup per unit by multiplying the markup percentage times the total cost per unit. And lastly, the 7th step is to determine the normal selling price by adding the markup per unit to the total cost per unit. So we have here the total cost per unit plus the markup per unit. So the we will be able to identify the normal selling price per unit. So to give an illustration, we have here the Digital Solution Incorporated is expecting to produce and sell 100,000 calculators. So let's say the direct materials is $300,000 and the direct labor is 1 million, and the factory overhead including the variable and the fixed cost is $1.5 million. So the given here is the selling and administrative expenses. So the total should be $170,000. So the total cost is $1.670 million, and the desired rate of return is 20%. So using the data given, the normal setting price is 18.30. So we can identify that by applying the steps. So first we have the total manufacturing cost, which is $1.5 million. So we already identified that the selling and administrative expenses is $170,000. So the total cost is $1,670,000. So for the 4th step, we have the total cost per unit. So we have to divide the total cost over the estimated units produced or sell. So we have 1,670,000 divided by 100 units. So we came up with 16.70. In the 5th step, we have here the markup percentage of 9.6. So how did we come up with that? So the desired profit in getting it, as mentioned earlier, is the desired rate of return times the total assets. So we have here 20% times $800,000. So we came up with $160,000. So the markup percentage is dividing $160,000 to the total cost, which is $1,670,000. So we came up with 9.6%. So the 6th step is the markup per unit of $1.6. So in getting that, we have 9.6% as the markup percentage multiplied by the total cost per unit, which is 16.70%. So a total of $1.60 per unit. So for the getting the normal selling price, we have to we have here 18.30, and in getting that we have the value of total cost per unit, which is $16.70 plus the markup per unit, which is 1.60. So summing of $18.30. Let us now proceed to the last topic, which is the variable cost concept. So these costs are included in the cost amount per unit to which the markup is added. All variable manufacturing costs, as well as the variable selling and administrative expenses, are included in the cost amount. So fixed manufacturing cost is fixed selling and administrative expenses, and the desired profit are included in the markup. So the markup per unit is then added to the variable cost per unit to determine the normal selling price. So we have here the following steps in order to get the variable cost concept. So first is to estimate the total variable cost. So as we all know, these are the direct materials, direct labor, and variable factory overhead. So the second step is to estimate the total variable selling and administrative expenses. Third is to determine the total variable cost. So in getting it, we have the total variable product cost plus the total variable selling and administrative expense. To give an illustration, so we have here an example of, let's say, the Digital Solutions Incorporated, and from the data of the production and sale of 100,000 calculators. So the normal selling price is 18.30. So in getting that, we have to apply the 7 steps. So first is to identify the total variable cost. So in the given data, we have here $1,450,000. So step 2 is the total variable selling and administrative expenses, which is $1.50 multiplied by 100,000 calculators. So we came up with $150,000. Third is the total variable cost, which is $1,600,000. And fourth is getting the variable cost per unit by dividing the total variable cost amounting to $1.6 million divided by the estimated units produced or sold, which is 100,000 calculators. So we have $16 per unit. So the fifth step is the markup percentage. So we have here the desired profit amounting to $160,000 plus the total fixed costs and expenses, which is $50,000 and $20,000 divided by the total variable cost, which is $1,600,000. So a total of 14.4%. So the sixth is the markup per unit. So we have to multiply markup percentage, which is 14.4%, times the variable cost per unit, which is $16. So a total of $2.30 per unit. And lastly, in getting the normal selling price, we have the total variable cost per unit, which is $16, plus the markup per unit, which is $2.30. So a total of $18.30. So that will be all for chapter 9. Thank you.